Hey everyone, Rob B here with Rob D, and it is the market update. We've got some cracking news stories for you this week. We're going to give you the areas that are performing the best for capital growth, but also bring you really good news on rental voids and what city is absolutely smashing it with rents right now. All of that coming up.
Welcome to the Property Podcast, where every Thursday morning, property investors come to be informed and inspired. Today, it's market update time. Lots of news has occurred over the last month, which we're going to be rounding up for you. So do make sure you stick around for that. First though, Rob, we've had some news of our own recently. It's been quite the week.
Yeah, I mean, this should be the dominant news story if I'm choosing it, but we won't. We've got lots of other stories to cover this week, don't worry. But yes, last week we officially announced that we're launching Portfolio, an app that we believe will transform the property investment industry. I know we've said this a few times, but we're generally blown away by the response. We had high expectations, but you guys have exceeded them and it's amazing. So the waiting list is growing and growing and growing. If you want to be part of that, then go to portfolio.co.uk. Nice and simple. So, Rob, while we feel it was a massive news story, there have been some other goings-on in the property world, so we might want to cover those as well.
Yeah, we should probably acknowledge some of the other things that have been going on. So lots to cover this month in the market update. We're going to be talking about rents, mortgages, and more. But, Rob, we always like to start out with the big picture. We'll start with house prices, and conveniently, the Home Track report is out, and our 2021 picks are still going strong.
Yes, so Home Track each and every month give us a 20-city summary of which cities are hot right now in terms of capital growth and which cities are not. You know what, Rob? I love opening any table and seeing Liverpool top. And Liverpool is top of the table here, with growth of 9.7% year on year. Fantastic growth for Liverpool. And that, remember, is the city. We've covered on the podcast numerous times now that it's the areas outside cities that are doing well. But the top cities in the UK aren't exactly, slumping or not doing anything at all. And if they have got more to go, then that's really exciting for those who invest in those cities. So Liverpool top at 9.7%. In second, Manchester, 8.1%. So very respectable. Third comes Sheffield at 7.6%. And Rob, this is pleasing to see at fourth, because I'm sure this was picked as well as one to watch, is Belfast at 7.4%. Belfast has languished for many years now and is really powering on. Some huge growth there for Belfast. And then just behind Belfast, we've got Nottingham, Leicester and Leeds. Bottom of the table, no surprise, it's the two that seem to be there each and every month, right at the bottom. Still barely with any growth at all. In fact, when you take into inflation, it is really falling in real terms, is Aberdeen with 0.2%. And then second to bottom, they look after each other. They're there together each and every month, is London with growth of 2.3%. So at least some modest growth for London. But Rob, as you've said, the cities that we picked at the beginning of the year seem to be performing quite well, but I think it's best that we move on before we start sounding a bit too smug.
Let's do that, but let's note before we do move on that the Home Track report also talks about the end of the stamp duty holiday. And it says that the stamp duty holiday, which finally came to a complete end at the end of September, looks like it's going to have minimal effect on the market. How do they know when it's only happened a few days ago? Well, because any sales that were agreed in the last couple of months would have likely completed too late. And when you look at sales over the last couple of months, there hasn't been a big decline in prices or in volumes. Now, we've said in the past that the stamp duty holiday, in retrospect, may not have been necessary at all. No one knew at the time, so I can't blame anyone for doing it. But we've been saying that it's certainly not the main driver of how bonkers the market has been going. And this seems to be backing it up because it's been withdrawn and the market hasn't really noticed, it seems. Something else that I barely noticed, to be honest, is that it's been party conference season, which means politicians come out and announce all the wonderful things that they're going to do, and the housing market is already high on the agenda. And the Conservatives' big announcement, their big vision, the thing that's going to change everything, is they're just not going to do what they said they were going to do before. So they previously announced some changes to the planning system. It was billed as this huge shake-up, but now there's been a bit of a shake-up in the cabinet, and Michael Gove, who's now in charge of housing, seems to be not so keen on the idea. So the plans for this planning shake-up have been paused. And paused in political terms normally means we just hope that everyone's going to forget we ever mentioned it in the first place. So not much action over there, but far more of an exciting headline, Rob, from the Labour Party conference.
It is an exciting headline, but if they do what Conservatives have done and actually just change their minds and just make big announcements and don't actually deliver on them, then maybe we shouldn't get so excited. I know I'm sounding slightly cynical, but that's because politicians have a track record of doing what they do, which is big announcements and not a lot of delivery. However, Labour plan to give first-time buyers exclusive access to new properties they've announced at their conference recently, which, as a headline, sounds very good. Now, in terms of the detail of that, it's very thin on the ground, and at least in the article from The Guardian. But what is interesting is that Lucy Powell, the Shadow Housing Secretary, has said a government led by Keir Starmer will restrict 50% of the properties in any development that can be sold to overseas buyers, which in some city locations has created ghost towers. Now, that's really interesting. Now, if that is the initiative, I don't see how that translates into first-time buyers having priority, but I understand why they're doing it, because you can understand a world in which more property would end up being presented to first-time buyers for them to be able to invest. Now, the information, as I said, is thin on the ground, so there may be other initiatives that in detail to follow that enforces first-time buyers to have access, but the overseas restriction, I think, is positive. And I also think it's measured. They've not said no overseas buyers. They've just put a cap on it at 50%, which I think is still a reasonable amount and seems quite fair. It's actually nice to see that Labour having more balanced policies rather than extreme policies that they've had under previous leadership, which scared a lot of voters off. I think the more balanced approach from Labour, but with good intentions, is a lot more welcome, certainly from where I'm sitting this morning. So, and hopefully for you listening to it as well. Although, while it does sound positive and does sound interesting, and we do want to help more first-time buyers onto the property ladder, we have to remember that an announcement doesn't mean it's going to be delivered upon. But we can hope.
Let's move on from prices and policies to rents, because there are some interesting figures that have come out recently showing that rental voids are at their lowest for 6 years. So the average amount of time for a property to be empty at the moment is 2 weeks, which matches its previous low from all the way back in 2015, and it's fallen by 30% since the start of this year. So as well as the property sales market performing strongly, the rental market is performing strongly. And Rob, moving into our next story, where the rental market is performing strongly is very interesting, because it seems like this trend of all the growth and the demand being outside of city centres is very much reversing.
Very much so. This article from Place Northwest starts with, and I quote, "Rents seem to be rising at ridiculous rates in the Northwest private rental sector, driven by students and new arrivals from London. Can the pace be maintained? Will the narrower build-to-rent sector also warm up?" And this is a really interesting article, and as always, all the links are in the show notes, so you can go and read this in more detail yourself. And if you're a property enthusiast, then I encourage you to do that. But one of the stats that stood out for me, Rob, is that an agency in Manchester has said that 3-bed flats to rent now are 27% up on last year in terms of the rental amounts. 27% in 12 months. Now, of course, 12 months ago, the market was a very different place. People weren't that hot on city centres, and possibly this is just a quick recovery, a very sharp bounce back rather than an aggressive price rise. 12 months ago, you probably got yourself something 27% under market value, roughly, in terms of normal rental levels. So I wouldn't be surprised if that 27% increase is just the market bouncing back to previous levels. It doesn't say. But even if that is true, and it's just it bouncing back to previous levels, how quick was that? I mean, that's not a long time for a recovery. That is rapid. And Rob, that's something we've seen through our own businesses as well, is that the market across the Yorkshire, the Northwest, in the major cities is hot right now. And Manchester in particular is booming.
Very much so. And interesting to see the data bearing out the observations that we've made just from being at ground level. Like you say, Rob, I think it probably is just going back to previous levels, but that is quite a snapback because it was performing so strongly before all the COVID restrictions. It wouldn't surprise me if when you zoom out a bit and you look at the chart over time, you'll see a very sudden dip, a very sudden recovery, and then it'll keep steaming on again. But we will see. There's also a pair of stories that caught my eye this month about the composition of the private rented sector, which is basically saying that the private rented sector historically has been for younger people who've rented until they're in a position to buy. But that is changing, and it's changing for a couple of reasons. The first is that the age of first-time buyers is rising, according to a survey by Compare the Market. And that's not surprising because house prices are growing so fast. So it is so hard for people to save up for their first property. And this is saying that the average age of a first-time buyer has been rising consistently for a long time. And they believe that in 10 years' time, it will have grown by another 1.5 years. So the average first-time buyer is 35 years old. But there are also more people being drawn into the rental market at the other end of life, and that's by choice. This is a story titled New Generation Rent, Why Baby Boomers Are Selling Up and Choosing a More Flexible Lifestyle. And it's basically making the point that for lots of reasons, renting is advantageous for older people for many reasons. And I think that represents an interesting opportunity for individual landlords, but it's also a demand that I expect build to rent to meet in coming years. Lots of build to rent developments are marketed at students, at young professionals, but there's a real opportunity there for the facilities and the stability to appeal to older people who want the flexibility of renting and also want to live in central locations. So I think these trends in the rental market are going to be interesting to watch in the coming years.
Moving on to holiday lets now, we've got a couple of news stories for you here. And the first headline reads, Holiday lets may be the next buy-to-let, says Moneyfacts. And Moneyfacts have done a bit of research, and it says that 63% of those they surveyed, it doesn't say how many people they surveyed, but 63% of them anyway, said they would consider holiday lets as a form of investment. And what's happened recently, it's no surprise that holiday lets are getting more attention and more people want to move into that sector. I think what's really interesting for me, though, in this article is that the money is moving there as well. Because according to Moneyfacts, there were 74 holiday let mortgage deals available 12 months ago. But now this has doubled to more than 186 different products. And the amount of lenders before was 14 different lenders, and now that's risen to 25. So that's really good news for those who are either in holiday lets because you have more finance products available to you now, or if you're considering it. Now, it's not something you should go into lightly, and while it may be the new buy-to-let or a growing trend, there's also a lot more to it than normal buy-to-let as well. So not to put you off, but just like we do with the podcast in general, is please do your research on any strategy before you go steaming in. But as I've said, Rob, for those involved or for those who want to be involved, that's really positive. Although not as positive, certainly for the people who live in Devon at least, Rob, is that Devon confirms 70% drop in private rental sector properties as terrifying as Airbnb trend bites. And that's right, in the last 2 years, the amount of rental stock for normal people to rent who live in Devon has dropped 70%. And that's because landlords have swapped to short-term rentals. Now, that may be the best thing for the landlords, and I've got nothing against the landlords who've done that because they've spotted an opportunity and they've adapted. But obviously for the people who live and rent in Devon, that's disastrous because it means that obviously their choices are limited, but also that probably prices are going to go up because of short supply. And this is where regulation has already started to come in, but will probably come in stronger forms in the not too distant future because it's unsustainable. And that's just something to be aware of. Again, it's not to put you off holiday lets, but be aware, just like there was with HMOs, it was pretty much free market with limited restrictions in the beginning. And then as it took off as a strategy, more and more regulation was brought forward. And there are many people still operating successfully in HMO after those changes, but lots of people also exited the market. And I think it'll be the same with holiday lets. It's pretty much a free-for-all at the moment, but let's see what regulation comes in over the next 12, 24 months. And then I think the people who are serious about the sector will stay, and those who've been a little opportunistic may revert back to traditional buy-to-lets, which, at least for those local communities, is a good thing.
Let's come on now to mortgages. And Rob, you've already talked about mortgages for holiday lets and how there are more options becoming available there. Mortgage availability for buy-to-let in general has also been improving and rates are still coming down. And there's a story from This Is Money talking about what they believe to be the cheapest buy-to-let mortgage ever. This is from the Mortgage Works, with one of the biggest buy-to-let lenders, possibly the biggest, I'm not sure. But they've launched a buy-to-let mortgage with a rate of 0.99%. That's right, you can borrow for under 1%. Just absolutely bonkers. Now, this is only on a 2-year fix and at 65% loan to value. And it does come with a 2% fee. So we always say that it's about more than the headline interest rate and you need to take the full costs into account. This is a great example of that. But what a headline rate that is, under 1%. There's not just the Mortgage Works going nuts on their own. There's also another product from Platform, which is part of the Co-op Bank, who are probably feeling really pleased with themselves when they launched a mortgage with a 1% rate, thinking that they would get all the headlines before the Mortgage Works undercut them by 1 basis point and grabbed all the headlines. But hey, those particular deals are not going to be suitable for everyone, either because of the fees or the length of fix or the loan to value, but still indicative of just how generous buy-to-let lending is at the moment.
Now, Rob, I can't believe this isn't a headline story because we're actually bringing landlords some good news around tax from HMRC. And don't get too carried away, though, if you're listening. They've not suddenly slashed all tax for landlords, but they have given us a little bit more time. What is happening? Well, the HMRC gives landlords more time to comply with new Making Tax Digital rules, the headline reads. And that relates to that landlords who fill in self-assessment forms with a business or personal income of over $10,000 a year from April 2023 had to go digital and had to fill in their forms that way. But the HMRC, because of probably them being a little overwhelmed at the moment, has extended that by a further year. So making stuff digital, you may be thinking, oh, what's the big fuss? You know, digital is better, right? Well, under the Making Tax Digital scheme, you have to do it 4 times a year. So kind of any efficiencies there have gone out the window and you'll probably end up doing more work than if you'd done it manually. So another year's respite from having to do all that extra admin is welcome. Not an announcement around tax cuts, but still something a bit positive from the HMRC, so we'll take it.
We'll certainly take it. That's been coming in for as long as I can remember. I don't wonder if it ever actually will. Something else that seems to have been going on forever is the extension of notice periods around evictions. Now, in England, they've recently returned to 2 months, which is what they were before COVID, and various measures were brought in to give tenants more security of tenure. But in Wales, they have not. The current requirement is to give 6 months notice of an eviction, and that has been extended until at least the end of this year, which landlords in Wales are understandably not pleased about. Now, of course, tenants who fall on hard times through no fault of their own, you can say they benefit from some kind of protection. But if you are unlucky enough to have a tenant who's not playing ball, it could be a very, very long time that you've been able to do anything about it. And in Wales, unfortunately, it has just got longer. And finally, this week, let's hit the final landlord bugbear. So we've had tax, we've had rules around evictions. Let's get licensing in there as well, because this isn't something that's going to affect all landlords. It's something that's going to affect very few landlords, but those who it is going to affect are not going to be happy at all.
No, if you don't have a property in the Lambeth area of London, you may want to feel slightly sorry for them, because HMO licensing has increased from £289 per bedroom for a 5-year licence, up by an astonishing 75%, to £506 per bedroom. So even with inflation going reasonably good guns at the moment, a 75% increase is huge. So people who are operating HMOs in Lambeth, which covers areas like Waterloo, Crystal Palace, Brixton and others, are really going to be forking out a reasonable sum of cash over to the council. We asked the councillor for a comment, but they sped off in their Lamborghini before giving us a response. So unfortunately, we can't give you any information from them. But landlords in Lambeth, I hope you get a good service for the amount of money you are paying, because you are paying a fair sum.
Well, that is it for this market update. We've covered a lot of ground this month, plenty going on. And I'm sure there will be plenty to talk about next month when we come back for our next market update as well. So keep on listening to the podcast. And in the meantime, you can find us on all the socials at Property Hub UK. So until we see you next, enjoy your week. Bye-bye.
Bye-bye.